Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, July 23rd, 2023. It's about quarter to 10 a.m. Eastern time. Let's get things rolling. I'm Wayne. My partner Ryan's working on our market outlook. Little beat. We've got some friends visiting in town this week, which has been nice. Here's our trusty disclaimer. And here's our trusty intellectual property rights notice. And I'm also moving my son home from having graduated from college a few months ago. And so we have a little bit of an abbreviated or streamlined program this week. Actually quite a bit of stuff, but in the interest of saving some time and getting on the road to take care of things, wanted to just kind of simplify this for now, and probably will bring a lot of points back starting next week or whenever it's suitable, put it that way. But I'll leave this up for another minute or so. I should say few more seconds. But yeah, this is a lot more streamlined from where we've been. There's just a lot going on right these days. So we'll get right into it. So a lot of today will really be about the fact that, right, we can sit here and we can trace this, that, or the other thing out on the charts and say this is one of the most likely scenarios. But really, the charts can be trumped by major FOMC developments, maybe something unexpected. Who knows, right? You also do not know what's going to happen with some of these very, very large mega cap companies that will be reporting EPS this week. That could turn into something. I've got a couple things down here that you may want to consider. Remember that we'll review this really kind of in some tabs and things like that, but there is still room on the charts. Well, first of all, last week did play out a little bit like we were expecting, I think. We said there's more room on the charts that they wanted. You're definitely already in overbought land, right? So we did get a little more upside, and then we got a little bit of corrective activity. So again, just kind of answering that question after asking it first, of course, would be, where am I? Where are we? That kind of thing. And we're in a tough spot, right? Because we think we're closer to the ninth inning than we are to the first inning by far, probably really near the seventh or eighth inning, maybe in the eighth inning already would probably be my best guess, the way that I'm viewing things right now. But that doesn't mean we can't have one more final push. I think the background information we're about to cover is important stuff. And usually it's not almost always entirely risk focused, but mostly risk focused, because you can get permeable information, I think, anywhere. We've always looked at it whenever we've done our own work for our own firms or whatever the case would be, that we always focus on trying to find some risks that may be bubbling up out there that only get covered after there's been, there's a major correction that started, or there's at least some significant corrective activity that started. So we still have more room on the charts, I think. But remember, that sweet spot, which we'll show, is basically, it's in the books. It's about to go in the books this week at the end of July, depending on whose take you want to run with. The third year of the cycle says things get bumpy for the next few months. The VIX seasonality pretty much says the same thing. So we're coming up to a time right now with the VIX below 14 that you could maybe think about doing some volatility positioning, and the Phoenix service is where to really go to discuss that with Ryan. He does a good job covering that in there. Stocks, we think, are at odds with economic developments. But at the same time, all the breadth we were saying that wasn't there several months ago has really appeared, right? It's really developed. So does that validate the rally? Well, I think what it does is it makes it where in the future I'd believe it a little bit more. I'm still not really there yet myself, which I'll mention. This is I think one of the major issues right now is we don't know if the gang ran some of these stocks or the entire market too far. And now we're going to see maybe possibly gap up exhaustions, where they gap up, sell on news, or if they're going to put a final push together that would really probably surprise a lot of people, myself included, that where things gap down and they just come in as screaming buyers right after that, and torque everything right back up again. Could happen. We'll see. Don't know. right? But you're barely removed from the recent high. It's just a few days of selling that we saw. So that's the big question too, which is, can they produce that sort of take your breath away? Like, my gosh, I thought it was already crazy. And then they goose that one final push before maybe we see some corrective activity. That would be my most likely scenario, is that whatever happens this week, you would expect, I think, in the near future, over the next maybe 8 to 12 weeks, there'd be some form of corrective activity. And then they'll probably try to get the presidential cycle back on track I should say midway through the fall, and maybe start to goose them into year end to make sure their bonuses are nice and healthy. But this is really it, right? So that's the bottom line. That's why I'm going through this right now. The fallout from the FOMC, the EPS reactions, those are likely to dominate this week. We'd still stay at DEFCON 3, at least I would. I don't think you're into DEFCON 5 because you're so late into this current rally, where there's probably should be some corrective activity, like as I said. So I think you have to be a little more ready than usual, and probably on your way to DEFCON 2 pretty quickly if you start to see where they don't like what the Fed has done or said, or both. They don't like some of these mega cap earnings, and they're treating them as more or less like gap up, sell on news to essentially, right, put an exclamation point on the fantastic run that they've had, and then liquidate and get ready to reposition later. This would be your active kind of hedge fund crowd type maneuvering. So I'm still having a really tough time buying what the perma bulls are selling, and still hope to be wrong. I've said that pretty much the entire time. And I still think you have to stick with these charts, right? Because we can talk about all these things we just mentioned, and then talk about even more. And the bottom line remains that, the market in front of us is what we have to work with, right? So let's reposition things here, and then I'll be able to get us into some tabs, and then we'll go from there. So just let me get back to screen sharing, and we should be able to share a different screen and get where we need to be. And that's screen 4. So share screen 4. And so this is our quick check, right? We're going to check on the percentage of stocks above their 20-day average. And here's the first one. It's the 20. The 20, we usually go through the 50 and 200 as well. And as I've said, right, it did get up there, but we've seen it where it's been higher, but still it did get up there. So I think that's another good reason sort of to be at DEFCON 3. Is it extreme? No. Is it getting there? Yes. Right. So I think that's gives you that perspective on what you normally see. Same thing for MMFI, right? Above the 50, stocks above the 50-day. Yes, it's getting up there. It's just not extreme. It's there, but has more room if it wants it. But at the same time, no one would be shocked if you did have some corrective activity from this level either. And then finally, MMTH, right? We take a look at these quite often. And you can see that this one has a lot more work to do, right? So again, if they want to continue this sort of push and working things up, maybe shifting to other names that haven't participated, if they really believe there's going to be a recovery and we're not in a recession and so on and so forth, then maybe there's more to come here. We just don't know yet. But kind of getting into the tabs, this is what's going on here, right? So it would be a real shock if we did not get anything but a 25 basis point increase this week. It's being assigned a 99.2% of probability by the Fed Watch tool. A reminder on the background, right, we're currently at have remained essentially right in extreme greed, and this has persisted for quite a while where we've been up here. So that usually means that you're on borrowed time, right? So just keep that in mind. This is really about painting that riskier picture in the background. This is often quite contrarian, and as you can see, the AAI members were well above, right, in terms of bullish, well above the historical averages. You could see the historical average is 37.5 for bulls. Right now you're at 51.4. If I'm not mistaken, this is the highest reading that I recall during this run from the October lows. So again, contrarian thing. Let's see what it says down here. I haven't even read this. 7th consecutive week. This has been the longest above average streak since the 13-week stretch from February to May 2021. So you have to go, well, yeah, so there you go. It does have a little mention of that. The only time recently that you've been higher on bullish sentiment was back in April 22 of 2021. So that's saying something, right? It is the highest that we've seen, and it even notes that right here, 1-year bullish high, right? So that tells you, hey, everybody's flipped around, much like they were despondent near the lows. You've got a lot of flip here, and you're way above the average. So, excuse me, keep that in mind. Again, this is all about painting that background, that risk-oriented or risk-focused background, so you appreciate where you're operating, right? The conditions you're operating within right now. Here's percentage of bulls minus bears from Charlie Bolello. You're getting up there, right? You're getting into that greedy range, the way that he's defining it. So remember, this is how much it flipped around. Bears outnumbered bulls by 43%. And so again, when you're at that really kind of beaten down level down here, right? Even though it's sort of is shocking, like how is this even possible? And this is what the gang's capable of doing, which is the reason why we look at these things, to remind ourselves of that and to appreciate, again, where we are and the risks associated mainly with where we are. This is the kind of major overview of that 3rd year in the presidential cycle. But I say it every week, but by far the best year of the 4, with next year being the 2nd best. But also this is nearly doubly as good as next year. So, but that next year's no slouch itself. Here's the 4-year cycle sweet spot we've been talking about nearly all year long, I think, at this point, maybe even further back. I can't even remember if we started to pick up on this late of last year or we picked up on this really more of this year. But I think it's early this year we started really talking about it consistently. But you can see that, right, you're sort of this, if you look at this year, right, from vertical line to vertical line, you can see that green spot takes you a little bit past the midway point. And so that's where I think we're at the tail end of the sweet spot. And you could see that during this part of the year, it gets a little choppy there, right? Typically. And so that's what I would be on guard for, is that you start to see volatility pick up. They've really goosed this thing dramatically. And that you right, notice what can happen with the NASDAQ. And I think the NASDAQ's had, quite a run. So it's kind of mirrored this pretty well. So I guess for those that are sort of keeping track of it along with me, you would expect things now to be a little rocky, a little more back and forth than what we've seen. And I think it becomes really like a nimble, you've got to be even more nimble and go for your singles and doubles unless really major cracks develop in the charts. If major cracks develop in the charts, then you could go for bigger downside. But again, you can't rule out more upside as unlikely as it appears to be, right? So if they keep goosing things, which again would make very little sense to me when I weigh that against the real world, but I still refuse to rule that out. I've said many times, the late 90s, the very last part of the 90s into 2000 have changed my mind about what's possible, right? And how far, let's say, afield things can get. There's a reminder on VIX seasonality. This is a little more updated, so you can see where things are. Again, if you want to delve into that, if you're not part of the Phoenix Portfolio Service, that's one I would take a look at and get in there, even for just a month or so. Learn some of the stuff that we cover in there that I think is very valuable for people that want to learn how to play defense, kind of have offsetting hedges, things like that. Here's another look at really the conditions that are not on the radar of Fin TV and a lot of these permeable talking points and so on and so forth. But here's your real gross domestic income. I can't verify, right, how good the signal's been, but the claim is that it's been a very good signal. If you do look back over time, you do see these gray recessionary areas. And you can see that, if judging by this, right, it does seem to have some validity to it, right? And you could see that we are where we are now. We're really dipping below the line. So it's another thing that suggests, right, that we are not really firing. I think, again, I think not a political comment, but I just think every administration finds new sort of reality obscuring techniques to develop, to cast their own performance in its best light. And I think that's why, like, over the course of time, the reports and things like that become less and less legitimate and genuine. But, people in power tend to not care about what's right, what's wrong, playing things properly, framing things properly, just the way, unfortunately, it's become, maybe always has been. But here's the Economic Cycle Research Institute. Another thing, essentially, right, you could see this has been pretty darn good in terms of recessions, and you are getting there, right, where some of your milder recessions, you're at where you see a milder, shorter recession, it looks like. But if you go deeper and deeper, right, I guess you get the even worse recessions, right, like the Great Recession, like we saw, as some people were calling it back about 15 years ago or whatnot. So keep that in mind. Here's another reminder on the yield curve inversions and how these have often preceded recessionary times. Here is something that is, again, not really being reported. They never really cover important data like this with any great number of headlines or spend a good deal of time on it, unfortunately. But you've got this credit spreads not reacting to building economic stress. So you're seeing building economic stress, it appears, right, where percentage of US states with unemployment rising is that brown line, and that's starting to roll higher. And you can see the bankruptcy filings are really also ramping up. So again, the backdrop to me is concerning. That's what all this is about. Here's the backdrop for stocks versus bonds. Right. So here's your equities relative to bonds. So this is when equities are overpriced relative to what you can do in the bond markets for a return. And so, again, the argument here is that you're relatively overbought. Only time we've seen anything higher recently is to go back to late 2021. The next one is, we saw that one. Okay. This one here, from Liz Ann Saunders. I thought she was with, she's with Schwab, I think. But you could see that you've got these vertical recessionary red shaded areas. And you're getting, here's your Conference Board US leading index of 10 economic indicators. Just doesn't look good, right? I mean, she's saying that the max drawdown of those is 9.9% going back to 1960. The index has never seen this magnitude of a decline without already being in recession. So again, just another sort of marker. Here's Philly Fed cratering, right? So 100% hit rate leading to recessions since the 1970s. They've already hit 31.3, negative 31.3 on this cycle. When you get below 25, it's had this kind of a hit rate, right? 100%. Here's another thing where housing starts dive 8% on top of significant negative reactions. Again, not going into the details, but this has been an area that I've been, in terms of like thinking they'd be in trouble, dead wrong, expecting them to be in trouble. Luckily, that's why I don't trade my opinion and just trade the charts. But because your opinion could just be at odds with what's really happening. So hedge funds apparently are leveraged up all over. There's the gross leverage, right? You're just off the highest high we've seen in half a decade, maybe more. So I don't know. That to me suggests something could happen, right? If all these chasers suddenly find themselves in trouble. The emergency bank bailout facility usage remains at record high, supposedly. Right. So, and QT is accelerating, but again, we've seen where this can kind of be talking out of both sides issue. So again, this is your risk backdrop. I think this is all pretty darn concerning. here's your red book retail sales, new 3-year low. And I could have probably included even more, but again, I'm really pressed for time. But here's something that came out from, I guess, Clearing Bid shared this, the consumer squeeze, right? So consumer balances and interest rates are both skyrocketing. So I think that they're tapping, the inference, of course, would be people are tapping things out of necessity, and they're getting really put through the ringer in terms of rates to do that. Again, assuming this data is all these data points that we've been discussing are accurate. So I think that's what you have to keep these things in the back of your mind. And I think they can't dominate your short-term trading, but this should keep you very, very much nimble, right? Like you should say, the rally we've had has been remarkable. The seasonality, all these various factors do have me very concerned. However, if the trend is still up, I'm going to trade it. I'm just going to be somebody who rolls more quickly. I'm going to be somebody who takes trims a few contracts for profits more quickly. I'm going to roll to out of the monies as opposed to slightly in the monies, like I typically like to when I'm really confident, because you're just playing things a little more smart, and you're going to have alerts set below your price action to say, look, if it gets to this point, I've got to know, because I may want to close everything and just reevaluate at that point. These are the kind of things that I do. Now, you don't have to go on offense, but you could, right? That could also be go from bull to bear, get ready to go from bull to bear. But remember, things normally, and there's always exceptions, but normally do not just plummet. You normally don't have this kind of an amazingly strong run in only 9 months' time, and then suddenly, right, it falls apart. News can do that. Certainly the COVID situation created something like that, but you don't typically see that where you just instantly fall apart, right? Even during, and I'll try to get us better data here, so just bear with me, please. But even during, right, the COVID times, which were back here, this is something that there's the COVID drop. And that did produce something like that. Luckily, we were covering this in classes from the early part of that year. We were ready for this. That produced that kind of quick drop. But in most of the time, you'll see a top take a little while to form. And then you finally get like this kind of situation here, right, that led to 2022. It's sort of this topping formation. Again, there's no guarantees. But that's the thing you normally would see, where they would sort of keep stock prices elevated, distribute for a while as people that are, I guess, none the wiser. Those folks are deciding, I'm going to add this, buy this, whatever, go along here. They sell out a lot of the inventory naturally that they've acquired from much lower levels. And then, right, once that institutional bid disappears in the aggregate, then they let things drop and they let the markdown of prices occur, and then they go back into accumulation mode, after things have bottomed. And you could see that bottoming process was a little wild, but they did bottom things, and from OC through early Nov, really to January, early Jan, and then what the goosing has been ever since we got into things. So the Qs didn't respond nearly as much. I think the spiders were doing a little bit more, but that could be wrong. Let's take a quick look. I think the spiders were doing a little bit more, a little sooner, maybe not. But then they came after. Yeah, I think they were there. So you could see that high, the low right there in spiders was significantly higher. So the Qs were just left there, right, relative to the SPYs. They became potential buying opportunity, and the rest is history. So that's what we've been seeing a lot of. We've been seeing a lot of UOA in things that failed to participate to the same extent as other names, other sectors, and then the gang will then rotate into those. They'll start coming for them, thinking, hey, this is a great chance to buy something that hasn't gotten marked up all that much to this point. So now that we've covered that real background information, I think we can take a basic look at the charts. But this is really, I think this week, as I've said, you can save yourself a lot of time, because no matter what I say here, the FOMC and these mega cap tech earnings and some of those comments, but the fallout from that, in other words, that's going to be right what dominates ultimately, I think, in the short run. And there are some gaps that were left in the spiders on the way up. There's a gap even back here. If we go back further, I'm sure we'd find a few more. So I think the risk is there. If you look at the RSI, and again, I'm not someone that instantly slaps on a bearish idea because there's negative divergence in RSI, but here you have this current high, you got that RSI reading, and you can see that you're significantly higher as of Wednesday's high, but this RSI reading was significantly lower. So that's a sign to me that, right, there's a little bit of weakening there. And again, my way of doing things is not to just start, just because you're overbought and there's negative divergence, to just start going all in on being a short side player. You know, I need to see something crack, and I'm going to manage it as a counter trend trade, which means I'm going to have it on an even shorter leash than I would normally. And I'm going to wait for something of significance to crack. And sort of, so the 20-day there in blue would be something significant cracking. But as you can see, that really wouldn't undo the trend. You really wouldn't make the argument that ultimately, if the SPY dropped over the next few weeks down to the 50-day, for example, you wouldn't make the argument that that trend is completely over and done. It would just be really a garden variety pullback after a remarkable run that the SPYs have had. But I guess you've got to be on guard, right? If I flash some numbers in terms of, you know, current RSI, some of those things, despite what we saw on Thursday and Friday, are still overbought. For example, as of Friday, even, you're at 68 on my daily RSI, 68 and change. So that's quite high, right? And just imagine where you were here on Wednesday. So you were at 75. So we were mentioning a little bit of this in webinars and in Rebel Pit, I think, just because, again, it's about understanding where you are, right, in the grand scheme at any given time. And I think that's what needs to feed into your short-term position management, what you're doing, right, in your positions, and how aggressive you're willing to be, or unaggressive you're willing to be, and so on and so forth, what you're going for, because you know that you know where you are, right? You know this is definitely got some risk dialed up, and the run's been very long and strong. But I'm still thinking it's at odds with economic realities for the reasons that you've seen. And so for me, I'm not willing to say it's a new bull market. Everyone's got their definitions. Well, if you rally by this, I mean, fortunately, we've been trading it on the bull side predominantly, right, since the lows got put in. Shortly thereafter, maybe a week or two, it was like, well, we got to give them the benefit of the doubt, because they had managed to turn things around and held them at that point. But as far as being a real bull and thinking this is the dawn of this new great era, I'm not a full believer in that yet. I hope to be wrong. I hope that my skepticism what is unjustified. I hope that we look back on that maybe at the end of next year, and I think I wish I would have been a little more of a believer sooner. But again, it hasn't hurt any trading. It just maybe has kept me from adding on on a longer term basis, where you're really positioning yourself more as an investor. But again, if that's the case, the rally will start a year ago when we get to October, and there should still be 3 to 4 years of rally in front of us. And so, or maybe more if AI, the AI delivers on the promise, but which I guess would be the Dr. Jekyll side of it, and the Mr. Hyde side of it would be, right, that it helps usher in even more dystopia. But that's a whole nother video. Anyway, this one here, right, similar situation, but you did back off a lot more, right? So this RSI is in, but you can see where the 20 is in the Qs. You can see where the 50 is. You've got a way to go, and you would look back and say, oh, it pulled back to the 50, and then it kept, started to bounce from there. We have to wait and see what happens. And remember, they could put there's still room here in my book, but they could use gaps to, again, they could create gaps like they do, get a lot of people chasing, a lot of people scrambling to cover shorts. And then what better way to again, liquidate stuff you've been holding or adding to for months and months and months than on this crescendo high, where you take things up and you get them not too far, right, from the all-time high. And right now, it would be one hell of a crescendo. I don't think they're going to be able to do that in the next week or two. Just that's a gut instinct call, not really a technically based thing. But I would be surprised if they're able to do that. But again, I wouldn't rule out that possibility. But regardless, right, because of all the hype and the goosing, they've got this stuff not that far removed from the all-time high. So if we sit here and think about it, 25, another 8, so call it 33. So you're just, I think you're within single digits of right. If you added 37 to here, that would be 10%. So you'd be beyond this high. So yeah, you're less than 10% away, I think, from being back at the all-time highs in the Qs, just to show you what kind of a run that's been. Is it a pretty steep run, right? Especially lately? I would say so. Could it get a little bit more steeper to close it out? Yeah, I mean, if you look at the steepness here, now granted, this is a counter trend short sort of squeeze rally, which I think earlier stages of this were. This might still be, but this can get a little bit sharper in terms of the vertical ascent, right? And that's why you maybe could see one final take your breath away rally. So again, I will not rule that out. This is not trying to equivocate. I'm not big on locking myself or anyone that watches videos into a mindset, because I think it's, given how very few of our plans work out to perfection in life, let alone in stocks. That's why I think it always pays to have a nimble mindset, a nimble approach, and go with the flow, right? If there is a holy grail, it's being able to not be locked in and learn how to be someone that adjusts without a really strong bias, right? That you're just like, well, this is what I need to do because this is what's working. This is what's not working. This is what's working. My job is to take advantage of things that are working and to not let things that are not working hurt me. If you look at it that way, you just go with the flow. But here's the IWM, like we said, this is one that we said, look, if this is really lagging, and we did say, I think a little while ago, it could be trying to break out, put another leg together, seemed to do that and then topped out where you'd expect, right up near these former resistance levels. This one here, this topping area back here. There's a lot of congestion from prior to that, and probably like with flat lines somewhere in this vicinity. So doing what it did, right? This because it's lagged so much, it didn't get quite as overbought. So there's still some room, I think, on this, and you just have to wait and see now and say, okay, well, RSI is still pretty up there. Probably would be healthier for this thing to try to back off a little bit more and then go. But it's not crazy right now, right? So if they were to start picking it up and running it, that would surprise me again in a way, because I just have to wonder how companies that are smaller, that do not have the economies of scale, do not have their own their own lobbying groups and all the rest of it. The ones that, these are not the companies that tell the regulatory agencies how to write the laws, and they're also the ones that tend to have to tap capital and get loans, because they're growing, or right, they want to take that next phase of expansion on and run with it. And they're not sitting on half $1 trillion or whatever Apple had at one time. They've got to go borrow at times. And so with rates having moved up the way they have, that to me would be sort of surprising, but again, maybe it will happen. And then finally, let's do diamonds. We'll do the diamonds and then a few other quick things, and then we'll wrap up. But yeah, I mean, you could see the run that's had, right? That's at 71 on my, basically if I round on my daily RSI. And so again, can't rule anything out, but odds are, right, I would expect that under normal circumstances, that would pull back small and then maybe hold above those highs right there. So that would just be like a 1% pullback or so. They go a little further, I wouldn't say that's out of the question either, maybe 1 to 2%. Maybe it comes in, finds that rising white 10 SMA, holds and goes. If you want to make the bull case, definitely lagging behind though, right? Much like the IWM, it hasn't had the powerful rally, certainly that the Qs, nor what the SPYs have had. But again, wouldn't take very long and wouldn't require such an enormous move to really get back to the all-time highs. I mean, you're only really what, about just roughly around 5% away. So again, on earnings, could these guys goose some things and create this forced buying of people covering and all that stuff? I think you can't rule it out, right? So that's the thing. You just don't know. That would definitely be a scenario that I would think is certainly possible. I've seen it many times, and it just blows my mind that people are not willing to just wait it out a little bit longer. But I guess the pain becomes too great. Maybe they're dealing with margin calls, whatever the case may be. But all in all, right, given that economic backdrop that we think we're dialing into with all the tabs that we covered and all the concerns that are out there, it seems like to me the market is simply just ignoring that for now. That does seem something seems like it would have to give, right? Where they either that data is about to reverse, it's weakened, and then we're just not seeing signs of it, but things have already reversed and gotten better. I don't think that's the case with what's happened with interest rates, but again, I could be wrong. Just my way of looking at it, just believing how important interest rates are. Especially right after we've seen the inflation that we have, because the price of everything virtually has been jacked up. So you have higher prices and you have much higher rates. And to me, that's a deadly combo for such a debt-dependent economy, society that we have here in the United States, because of, well, decades of either or intentional mismanagement. But the case remains, right, that short term, this is overbought. This did leave a consolidation. So if you're a bull here, you probably would actually welcome a nice 1 to 2% pullback. You kind of put a flat line in there somewhere, let's say near there, just around, say, let's just say 346, something like that, 347. You pull back 1 or 2%, you find that, and then you go. And that's going to be a little bit of confirmation that what was resistance may now, in fact, be converted to support. That might open you up for another leg higher. And I have seen summers like that in all my time in this, where it just keeps drifting into the fall. And then there's a reckoning, because it just, again, that drift just kept happening, and it was at odds with the realities that were unfolding beneath like the surface of these stock prices. But that's kind of the quick rundown. I'm not going to go into scenarios and so on and so forth, because everything could be trumped with whatever Jerome Powell utters on Wednesday after the announcement. The announcement itself could be surprising. We just don't know. Here's the dollar. It's gotten really shillelied pretty badly, and it's trying to come back. So again, rising dollar, stronger dollar, not good for stocks, generally speaking. Yields the same, right? 10-year yield. Doing that, not all that great as well. And then nothing special. Let me get you a little bit more time here, but nothing special in terms of what's happening there. Trying to lift off of the SMAs, which it's done a few times. So it bears watching, right? It bears watching, but I'm surprised, right? I'm not surprised that it had a sort of a false breakout. I'm just surprised that it just hasn't been able to stick near the high. Maybe they'll get it up, move things up a little bit higher and back towards that recent high before the FOMC, and then maybe the FOMC sends some message to it where it starts to make a larger move one way or the other. And then finally the VIX, right? And that's just been again, you really can't chart the VIX the way I look at it. You just really can't chart it like it's a regular equity. It's entirely different situation, since it mean reverts a lot, and it tends to, well, these days, I think it tends to be very suppressed by the powers that be. But overall, right, you're not very far removed. You're not even 1%, or I should say, you're not even one tick off the lowest low we've seen in years. So it's still right when you're only a little bit above that 1273 level. That to me means you're still in a prime position to position yourself the right way in terms of volatility and what you can do with it against your portfolio risks, or maybe in addition to your portfolio risks, really for the balance of this year into next year. And so just, I always try to convey what my way of looking at this to folks. A simple way that you can think about it is the game of Monopoly, where you really want to own certain properties, and the ones that pay the most rent are the ones that you would love to have, right? That you're going to get that frequency of hitting, and when someone lands on there, they've got to pay a pretty high dollar amount. And with respect to those, that's how I look at sort of volatility positioning, where generally speaking, the year unfolds in a way that's similar to this year, where you tend to be more bullish through May. Then you kind of, sometimes there's a little bit of a June lull. They put together a good July. Then you kind of go into this rough patch, and then they usually finish the year fairly well. That's usually how things work out. So I like to own the places where the volatility is likely to really pick up, because there's going to be some really serious bumpiness. But I don't like owning the summer. So I tried to buy October, November. Those are some of my favorite months to own that are coming up. November's probably my preferred one over that. But just in case things, if there is difficulty, it'll cover me through fully through October. And then I tend to go out to February and March and own those, and I skip over January and December because they could be subdued, especially if they rally into the year end. And then sometimes the market doesn't really pick up and start to really act like the market kind of has a holiday hangover for the first few weeks of January. And sometimes when that January expiration falls early, it's sort of like, wow, I got nothing out of that. So I always found February and March, May to all be months I'd rather have sort of in the winter and spring. And then so if you sum it up, I'm more about, sometimes you get stuck with January. We used to, just because you were a market maker making leap markets, right? So you end up with a lot of that sometimes. I tried to roll it out a little bit every time I could, though. But I would stick with owning Feb, owning March. These are when there's these are also times, when you can get decent movement, and May. And I would also own OC and Nov. Those are my 5 to own. And as for the rest of them, I would tend to sell things that were not earnings related. So depending on when the company reported, I would try to avoid selling earnings. I would try to actually buy earnings and then sell around it, prior to and far after, to keep theta and all the other Greeks well balanced and kind of shaping up the way I like them. But having said all that, that's where the VIX comes in. I think you could start being pretty smart about what you do. And this is not a pitch for Phoenix portfolio, even though I have mentioned it a lot lately. It just, that's the reality of, that's where we spend the time in that service, covering different things like that, different considerations that can really be a nice little add. You can make money, from volatility alone, or you can at least protect yourself in different ways. And that's where we cover that. So I hope, as always, that something I share with you helped this week. Sorry if you were looking for heavy duty TA, but again, I think it's somewhat futile, because we can go through all these different permutations and probably mega cap what they say, what they report, and what Jerome Powell and his friends do and say. That's probably really what determines the outcome of this week. And I would just say, look, be prepared, right, to be nimble, right? If you've had a great run, I would tidy things up and just really reduce my risk. And remember, a lot of times they'll throw a few head fakes at you post Fed. So the Fed announcement gets made around 2 p.m., should be 2 p.m. exactly on Eastern time on that day, which is, I believe, Wednesday. And then you usually get a move, they fade that move, and sometimes they fade the second move, but it's all the same old shenanigans typically. So you got to be prepared for that. And then people usually wait to hear what he has to say before really deciding our fate, what happens with our stocks. And then by the end of the week, it could be a different take from what they first thought. I've seen that too. So that's the thing. I think this is a prime window for game playing, which means you have to really be on your top form for nimble position management. And until you see support break in this market, or some major stock starting to really take the last train for the coast and just getting out of here, you probably want to just believe in the trend until you have good reason not to, right? Just because these things do persist kind of in the face of everything like we've discussed. So again, hope something helped you out. Going to try to get sector situation taken care of quickly. And then I've got to get on the road to help my son move home after having completed his time in college. And so on that note, I'm going to wish everyone a great conclusion of your weekend, and I will see you through updates, etc., webinars, all the rest of it this week. Thanks for tuning in.